I'm very happy to welcome you to the PwC Corporate Tax Reform 3 webcast at this nice and sunny Wednesday afternoon. I'm very happy to have you all attending this WebEx session before going into the well-deserved evening break. It is about the update we would like to give you concerning the results of the parliamentary process. The Parliament, as you may also know, have finally made decisions last Friday on the final package for Corporate Tax Reform 3. Before we start, let me allow you to give you a few logistical remarks. It is possible to ask questions, and I very much would like to encourage you to ask questions by pushing the question button at the far right-hand bottom on the page. You have a button there, and a window should pop up which allows you to ask questions. These questions will be submitted to us here at the speaker desk, and we will endeavor to answer these questions at the end of our Q&A, or if we can, to already build them into the presentation as we speak. So please feel free to ask whatever question springs to your mind in the context of what we are presenting, or generally in the context of the Corporate Tax Reform 3 package, and we will try our best to answer these questions during the WebEx session, and if we should not be able to manage all questions during the WebEx session, we will follow up individually thereafter. Before we start, let me introduce to you the presenters. Myself, Armin Marti. I'm the partner at PwC Zurich in Zurich, leading the Swiss corporate tax practice, and I'm a member of the technical working group that has helped the administration and the federal tax authorities and the finance department to develop the bill, which has been discussed in the parliament and now resolved. I'm sitting here together with my partner colleagues Benjamin Koch, who is also a member of the technical working group and has contributed substantially to the crafting of the reform. He is leading the transfer pricing and value chain transformation practice of PwC here in Switzerland. He is based in Zurich. And our third speaker today is Claude Alain Barque. Claude Alain is also partner of our tax and legal services based in the Romandie in Lausanne, and also he has been very active in giving input to the Corporate Tax Reform 3 developments, especially in the Romandie. The content of our today's 60 to 90 minute WebEx webcast is to very briefly give you an update on the Corporate Tax Reform 3 in a nutshell, give you an highlight, an overview of the Corporate Tax Reform 3 measures that made it finally into the package, show you the timeline of the next steps until enactment. Then Benjamin Koch will cover the cantonal patent box and the R&D input promotion topic. Claude Alain will then explain to you the status on the notional interest deduction measure, and I will take over again for the disclosure of hidden reserves, the step up, the other measures including cantonal rate reductions, and make some few remarks on the funding of the reform package, and last but not least will guide you through the Q&A session. Now, as you know, Corporate Tax Reform 3 is about abolishment of the current cantonal privileges of holding mixed and domiciliary companies, the principal allocation mechanism at federal level, and the Swiss finance branch rules also at federal level. But the companies impacted by the reform are not only those who historically benefited from one or several of these regimes, but generally all companies, even without the tax privilege, which either have a business activity with high level of equity capital and group financing or group financing. Businesses with a high level of activity in the area of R&D, and generally businesses planning investments in Switzerland, but obviously all Swiss companies will be affected, in particular also by the announced rate reductions at the cantonal level. So our sort of immediate recommendation to you is, to the extent not done yet, perform an impact analysis, what the new reform measures will mean to your business. There is flexibility still to influence the reform at cantonal level, and there the call for action goes into lobbying for the right implementation in the cantons, and we will explain a bit further on what the flexibility elements are which the cantons can use when crafting their cantonal implementation package. And of course, last but not least here on the list, execute planning to optimize the effect of the reform on your businesses. Now let me come to the overview of the Corporate Tax Reform 3 measures. You may perhaps recall this temple with the measures which we had shown in earlier webcasts in the process of the parliamentary debate and before. What you see here is the list of measures which have been approved by the Parliament last Friday, split into the measures that are going to be implemented into the federal direct income tax law, those which are in the cantonal harmonization law, which then need to be translated into the cantonal laws by the cantons, and other measures. And you see a small box or a big box at the far right-hand side with measures that were discussed but are no longer forming part of the package and will be sort of dealt with separately. So what we have from an overview perspective is at federal level the introduction of the notional interest deduction on excess equity, and as a second measure the step up of hidden reserves when entering Switzerland, but also when losing the status of a principal company. At cantonal level, there is a bigger series of measures for the cantons to implement: the mandatory cantonal patent box, the R&D super deduction regime. The notional interest deduction is optional for the cantons and subject to the condition that the cantons also introduce a partial taxation of private dividend income of at least 60%. In average, cantons today tax private dividend income at 50%, some cantons higher, some cantons lower. So for those cantons that have a lower participation taxation currently, they will need to change that and increase the partial taxation to 60% in order to be allowed to actually introduce the notional interest deduction. Then the adoption of the cantonal capital tax, particular transitional measures regarding the treatment of formerly tax-free hidden reserves. This addresses the situation when the companies lose their cantonal tax regime. Then there is a new maximum limitation of all tax reliefs that may not exceed 80% in total to secure certain minimum amount of tax revenue for the cantons. And then in the section of the other measures, there is the increase in the cantonal share in the direct federal tax revenues, which is important for the cantons to actually receive more funding from the federal level in order to allow them to reduce their cantonal tax rates to some degree. Then, in addition to the other measures, is the lump sum tax credit for branches. Previously we had only a lump sum taxation availability for companies. That shall be extended now to Swiss branches. And last but not least, the pretty technical adjustment in the Finance and Tax Equalization Act, which deals with the adjustment of the resource potential for companies that avail themselves of a so-called early step-up according to current practice. And this measure is designed to avoid a disincentivization by means of the finance and tax equalization mechanics of those cantons that have a big number of regime companies. This is important to actually allow these cantons to continue their practice upon loss of a cantonal status or cantonal regime, to allow a step up according to current practice rules. Deferred into a separate bill are two measures: the abolition of the issuance stamp tax and the introduction of a tonnage tax for shipping companies. These two topics have been discussed in Parliament, but the Parliament decided not to overload the overall package at this stage, to submit these two topics to separate processes, to separate bills that will be dealt with separately. Now, as I said, at the cantonal level, where the next stage of the political debate will start soon, at the canton level there is some flexibility for the cantons to choose out of a bit of a menu from the canton harmonization law provisions. Here on this slide you see the overview which measures are mandatory for the cantons, marked with yes, and those which are voluntary, optional for the cantons, marked with no, and the scope of action the cantons can do with each of these measures. Regarding the cantonal patent box regime, it is not optional, it's mandatory. All cantons need to implement that regime, but they can determine the maximum reduction, and Benjamin Koch will explain what that means. The cantonal R&D tax credit, or the super deduction, is optional for the cantons, and the cantons have some flexibility to tailor the regime, and Benjamin will sort of explain that in more detail also. The notional interest deduction is optional for the cantons, as already said, subject to the condition that the partial taxation on private dividend income is increased, where this is not yet the case in those cantons, to 60%. Claude Alain will explain more about this measure. Then we have the transitional rules concerning formerly tax-free hidden reserves, the step up. There we have a separate rate taxation transition rule for 5 years post enactment of the reform. I will explain further details on that later on. Then the new measure which the cantons were keen to implement is the overall limitation of tax reliefs, taking care of the cantons' concerns that if certain companies would benefit from more than just one of the new measures, that in accumulation these measures would erode the taxable profit at cantonal level entirely. And to stop this sort of full erosion risk, they introduced a maximum 80% limitation for all reliefs in combination, and this 80% limitation also includes any depreciations from early step up according to current practice. Then we have the additional cantonal capital tax adaptations, where the cantons can choose to implement a reduction of capital tax for participations, patents and equivalent rights, plus intercompany loans. Tonnage tax and issuance stamp tax, I already said, are deferred, two separate bills. The cantonal share on federal tax to be paid to the cantons is fixed from 17 to 21.2%, so no flexibility there. And the cantonal tax rate reductions obviously are at the full discretion of the cantons, and the cantons will do whatever is feasible depending on their cantonal tax strategy and obviously also their financial strengths to lower the tax rate and remain very competitive, both in the intercantonal competition, but also much more importantly on the international tax competition. The process which still has to be concluded is after the parliamentary decision last Friday. Next step will be the publication of the law. From that moment, a 100-day period starts during which a referendum can be called, and it seems sort of very likely that this referendum will be called by the left-wing parties. They have announced already quite early in the process this spring that they will go for calling the referendum, collect the necessary votes or signatures from Swiss citizens so that a popular vote will become necessary. Very likely the popular vote will be pushed sort of to be done as quickly as possible, and it may be already in February 2017 that the Swiss citizens will have to vote on the reform. Once the vote has been successfully passed, then the Federal Council can set the effective date of the enactment of the new rules. Unlike in earlier proposals, there is no longer a 2-year transition period prescribed in the law, during which the cantons can implement the harmonization law provisions into their cantonal laws, but the Federal Council will set the enactment date for both the federal norms and the cantonal norms at the same time, and it is targeted currently for beginning of 2019. At that time, if cantons should not be able to translate the harmonization norms into their cantonal laws because of, for instance, also popular vote becoming necessary at cantonal level, or simply because of delay in the political process at cantonal level, then the harmonization law provisions, most of them will become self-executing and apply directly at cantonal level, irrespective whether the cantonal law has been enacted in time. So this is the overview of where we are from a procedure point of view, and with that I hand over to Benjamin for the details on the cantonal patent box and the R&D input promotion measure. Benjamin, please.
Thanks, Armin. The purpose of this section is to provide you with a high-level overview of what was currently agreed in the Parliament with respect to the patent box and the research and development promotion. The structure of the presentation is as follows. First, I would like to give you an overview on the main elements of the patent box. Second, I would like to discuss with you what we know about the input promotion. And third, let's have a look at the next steps, and in summary form, what are the key messages. Let's start with the patent box. The patent box and the promotion of research and development as regulated in the new tax harmonization law addresses the fact that certain activities within a company's value chain are highly mobile and are typically taxed at a lower level. Before we dive into the details of the proposed measures, let me quickly provide you with a high-level overview. As mentioned already before by Armin, the promotion of innovation, so the input support, can be done on the back-end side via the patent box and or at the front-end side via the R&D input credit. However, the introduction of an input support regime is voluntary for the cantons, whereas the patent box has to be implemented by the cantons on a mandatory basis. The patent box, as regulated in Article 24, litera A of the new tax harmonization law, provides the taxpayer with the opportunity to make use of a beneficial tax regime with respect to net earnings coming from intellectual property. In this respect, the first question, of course, is the definition of the qualifying IP. As you know, international developments, particularly the BEPS initiatives and the publication of Action 5, Countering Harmful Tax Practices, provides the framework of how a patent box can be designed. BEPS Action 5 provides 3 categories of intellectual property rights. Category 1, patents and other assets that are functionally equivalent, so for example also utility models. Category 2, copyrighted software. And Category 3, none of the first 2 categories, but qualifying IPs which may be patentable IP. However, only for small and medium-sized entities with a group-wide turnover of less than 50 million and less than 7.5 million euro IP revenues. What we can read out of Article 24 is that Switzerland will follow these guidelines, and the Parliament gave instruction to the Federal Council to define, via an ordinance, the meaning of equivalent rights, but mentions in the law copyrighted software and non-patented innovation. Substance requirements are critical to implement a sustainable solution. With reference to international developments, an entity which qualifies for the patent box should substantially contribute to the development or further development of a qualifying IP. From an international perspective, substantial contribution can only be a nexus to local research and development activities. Hence, as a consequence, and also based on an arrangement reached by Germany and the UK, the modified nexus approach is the substance requirement to be met in order to calculate the respective part of a beneficial tax treatment of IP income. Also, this is not explicitly mentioned in the law. The expectation is, of course, that the ordinance, which needs to be drafted, has to address the nexus approach in a way that respects the international framework. Also not mentioned in the law, but in the supporting documentation to the proposed law, is the mechanism to calculate the amount which is subject to a preferential tax treatment. And this follows a residual approach, whereby in a stepwise approach, the respective amount is calculated. In a first step, all revenues and costs with origin in financial activities are deducted. In a second step, all revenues and costs with products or services which are not based on a qualifying IP will also be deducted. And as a next step, the net license income, i.e. revenues minus the respective costs from third and related parties, will be transferred by 100% to the box. And as a last step, from the remaining residual, a remuneration for routine activities as well as a remuneration for marketing intangibles, which are not qualifying intangibles, will be deducted. However, there is also an entrance ticket to the box. It is foreseen that at the time of the entrance of an IP into the box, all the respective R&D costs, and in addition, any benefits received under the input promotion scheme, which have reduced the taxable profit in the previous years, need to be added to the taxable profit of the first year you decide to go into the box. The Parliament has decided that this taxation needs to be secured over a time of not more than 5 years, e.g. the cantons may decide to implement the taxation, which does not lead to an immediate cash out for the company at year 1. After the stepwise calculation of the patent box profit, a maximum multiplier of 90% has to be applied in order to define the base reduction. Cantons may further reduce this multiplier. The mechanism is illustrated then on the following slide, and which I will cover in a minute. However, as defined in Article 25, litera B, the total benefit from the application of the patent box, the R&D promotion, step up, and NIT is limited to a maximum of 80% of pre-tax profit before offsetting losses. This slide summarizes and provides what I just said with respect to the approach, to the residual approach. Step 1 illustrates the stepwise approach to define the amount of taxable profit subject to a preferential tax treatment with all the elements I previously mentioned. Step 2 provides the nexus ratio, i.e. the ratio of qualifying expenditures compared to the overall expenditures to develop an IP. That ratio is used to multiply the result after step 1. Step 3 is the maximum base reduction of 90% the companies are allowed to apply to the result of step 1 and 2. As I mentioned before, cantons are free to reduce the 90%. The result of the multiplication of step 1, 2 and 3 is the part of the total profit which will not be taxed, i.e. the total amount of the base reduction. Let us have now a closer look to the research and development promotion scheme. As per Article 25, litera A of the tax harmonization law, the cantons may implement an R&D promotion scheme. A typical process would actually start with the definition of what kind of innovation shall be promoted. The law is silent on this aspect, and hence the cantons are free to define what kind of innovation they would like to promote. This makes absolutely sense, since every canton has a different industrial setup and as a consequence can draft and define in a law what is relevant for the respective region. There is also no guidance on the cost base to be applied. However, the law delegates to the Swiss Council the definition of R&D costs in an ordinance. The law applies a so-called super-deduction regime, whereby R&D expenses can be deducted with more than 100% for tax purposes. As an example, for every Swiss franc R&D expense, the company can deduct, for example, 1 Swiss franc and 50 cents, i.e. applying a multiplier of 1.5. There was a political debate whether only Swiss R&D but also foreign R&D should qualify, but finally the parliament decided that only R&D expenses in Switzerland, either through the company itself or by third parties, qualify for the regime. However, there is a cap of 150% to be applied on the yet to be defined cost base. In case R&D is performed in different locations in Switzerland, then the principal is allowed to benefit from the regime, but not the contracted party, if the principal is entitled to respective benefit. So there is no double dip. Last but not least, as already mentioned, with the patent box, the total benefit from the application of the patent box, the R&D promotion, the step-up and NIT is limited to a maximum of 80% of pre-tax profit before offsetting losses. Certainly, from an overall perspective, the R&D input promotion is a reasonable means to further enhance the attractiveness of Switzerland for high-value creating activities, and may help to partly reduce the higher cost level operating in Switzerland. Furthermore, since 27 out of 35 OECD countries, plus other non-OECD countries such as China, Brazil and Russia already have an R&D tax credit system, it is pretty reasonable to assume that such a measure is broadly backed up internationally. What are the next steps? You already know this slide. The Parliament has voted with a comfortable majority of roughly 70% in favor of the corporate tax reform. This was a strong signal. But as always, the devil lies in the details, i.e. the law as decided needs to be broken down into ordinances. This is currently the process the federal tax authorities, together with the cantonal tax authorities, is performing. It is envisaged that this process is completed this summer, before all interested parties are consulted to give their feedback and make sure that the implementation follows a pragmatic approach. of course within the guideline as established by the international bodies. The combination of a patent box and the promotion of R&D input will lead to an internationally accepted and attractive regime to promote even further innovation in Switzerland and to attract foreign investment. Hence, a broad variety of companies, whether small or large, will benefit from those regimes. There is still lots of flexibility for the cantons to position themselves in an attractive way within the given framework. Now, since the law is passed and thinking positive that the Swiss population will vote in favor of the corporate tax reform 3, it would definitely make sense for companies to address the relevant questions on patent box and R&D promotion to see whether they can benefit from those regimes. Moreover, with a more holistic view, each element of the law as passed by the Parliament needs to be analyzed in combination to set the right strategy for the time after the federal and cantonal tax authorities will withdraw the tax regimes currently in place. This said, I hand over to Claude Alebarque, who will discuss with you the proposed notional interest deduction regime.
Thank you, Benjamin. Indeed, the need is a very long story. It took a long time to bring the need back to where we are today. If you remember, the Federal Council's draft proposal did not include the need. Why? Because the Cantons said that a need would only reduce the tax rate, so they were lobbying for having a general reduction in their corporate tax rate, and applying a need to every taxpayer would be the same result as having a reduction in the corporate income tax rate. On the federal level, of course, this was or is one of the sole measures that applies also only to federal taxes. Thus, it's also a matter of budget for the Confederation. And a third element why the Federal Council did not put it into the draft bill, there were discussions about international acceptance at that point in time. During the parliamentary discussions, there were intensive lobbying activities that took place. PwC was part of these intensive lobbying activities in order to bring the notional interest deduction back into the bill. Why was it important to bring it back? Today we have in Switzerland intensive financing activities out of auxiliary company regimes, out of holding entities, and out of the finance branches. So it's absolutely crucial that we can offer replacement measures to those companies and taxpayers that are benefiting from these measures today. But in addition to that, we want also to attract into Switzerland new business. So it's important to be able to offer for the future also attractive new offerings. So how does the need look like from an international perspective? The need is currently not classified as a harmful measure, neither from the EU nor from the OECD. We have several European countries that are practicing the need directly, and other countries with different measures arrive to the same result. With regards to BEPS, the need is a key element to foster the consolidation of substance, because BEPS is a matter of substance. So the need gives an incentive to companies in order to consolidate their mobile finance activities. So, and where did we end up with our need? Well, the need became what I call compromise. For me, the Swiss finish. As already said, we have it optional at cantonal level, but it's linked to the taxation of dividends for individuals. So I'm not sure that companies that are benefiting largely from the need in the future will be those held by private individuals that will be paying the private taxes on the dividends. But again, this is a political compromise. There was a given and a taken. The other specificity for the need is that we have a need on surplus equity, so it's not on newly created equity, it's not on total equity, it's on surplus equity, and we will see what the surplus equity is. The expected effective tax rate for large financing activities should be ranging between 3 and 6%, which gives a very good international indication. If you look into more details, as already said, it's a mandatory measure at federal level, it's optional at cantonal level, and it's linked to this particularity of the taxation of private dividend income from qualifying participations. The crucial element is how to determine the equity basis that will be benefiting from the deduction. So you need to determine the surplus equity. And the surplus equity is calculated taking or determining the core capital. And the core capital is based on equity requirement rates that are applicable to specific category of assets. So it's a kind of, it takes elements of the thin cap calculation principles. It's not a thin cap calculation mechanism, but it takes the elements of that. There are certain assets that are excluded from the calculation. Those assets are the investments. Of course, it's in order to avoid the duplication of the deduction. Then assets that are not required for operating purposes and hidden reserves that have been stepped up. And at canton level, patents that are benefiting from the patent box are also excluded. So I think this will be the tricky part in making the Excel sheets, how to determine this core capital and the surplus equity. With respect to the need rate, we have a safe harbor rate, which is defined by the 10-year Swiss federal bond rate. And we have an arm's length interest rate that is specific to each taxpayer for specific financing activities. There's also an anti-abuse provision which avoids artificial creation of equity. And again, we find the limitation, the 80% limitation, which my colleagues have already commented, in order to avoid that the cantonal tax base is fully eroded. Also, the need is subject to this 80% limitation. Of course, an important element is the equity tax. If we attract equity into Switzerland, we know the equity tax, so there's a special provision that allows the canton to exclude or to reduce the tax rate that is applicable to this portion of equity that corresponds to financing activities within the group. There are hundreds of detailed questions that will need to be explored before the first tax file will be able to be filed. So the Federal Finance Department has the responsibility to issue the necessary regulations, and we're looking forward to participate in the workout of this document. In order to make things a bit more concrete, a short example how to determine the surplus equity. The starting point is on your left-hand side. You have the operating assets at corporate income tax values. So we take book values, respectively tax book values. We take out a certain number of assets, which are stated at the bottom of the slide. And on each of those assets, we apply an equity requirement rate. And this rate will define the minimum required equity, what we call the core capital. And whatever equity that is in excess of this core capital will qualify as a surplus equity on which the need can be calculated. And on the very right-hand side, you can see the gray box, and the gray box represents the thin cap calculation. So we expect that the equity requirement rates will be different from the thin cap rates, thus the core capital will be higher than the minimum thin capital according to the SFTA rules. And then the taxable equity minus the core capital gives the surplus equity. So the need rate, as said, there are two rates. There is a 10-year federal bond rate, which is currently inattractive because it is negative. And there's a taxpayer-specific rate, which is an arm's length rate for the financing activities. So the surplus equity that can be allocated to intercompany loan receivables, thus to a financing activity within the group, can apply an arm's length interest rate, which makes the thing very interesting. Of course, if you have different assets, so if a company is not only doing intercompany financing activities, we'll have to have a mechanism in order to allocate the surplus equity between the different categories of assets in order to apply the correct need rate. So, the anti-abuse provisions, of course, tax planning. What would you like to do in order to benefit from the need? You would like to create equity and at the same time to create receivables against the group entities in order to benefit from the higher need rate or the arm's length need rate. So the anti-abuse provision states that EU are not allowed to do that. So the left-hand example is a disposal of investments. Top holding entity is selling investments to a subsidiary, whereby creating a capital gain which increases the equity and at the same time creates a receivable against the subsidiary. This intra-group restructuring will not allow to increase the need deduction. At the same time, distribution of dividend from a subsidiary to the parent, which is left outstanding, so the dividend is not paid in cash, but it's creating an intercompany payable receivable, will also be disallowed from the need, because you have here increase in equity through the dividend and the creation of a receivable at the parent company for the dividend to be received. A very simplified example for a finance company that is fully equity financed with loans to rated party of 100 million. We suppose that the equity requirement rate in order to define the core capital will be 15% for this kind of activities. So we have core capital 15 million and the surplus equity on which the need should apply is 85 million. In this example, we have an interest rate income of 5% and the arm's length notional interest deduction specific to this taxpayer is 3.25%. The combined effective income tax rate in the canton is 18%. The profit from the interest is 5 million. You make the need deduction at 2.7, gives the profit before tax of 2.2. Taxes at 18%, 400,000. The effective tax charge is 8% in that case. So there's a substantial difference, and you can see that this is a substantial benefit in this situation. We have been trying to modelize this. If you see this slide for the first time, it's a bit difficult to understand. The green line on the top represents the current effective tax rate in the cantons from the best to the worst. Worst is Geneva. So it's based on the current. It's not based on the future tax rates, but on the current. And then we have different scenarios on the spread that remains with the finance company. So we have a spread of 35%, we have a spread of 70%, and we have a spread of 3.5%. So the dark blue line represents the evolution of the tax rate in the different cantons between 5, 6 to 10, 11%, with the high margin on the financing activity. And if you take the red line and the light blue line, we are between 2.5 and 5% of effective tax rate. And the question why these two lines, the red one and the light blue one, are in parallel is because in this case the 80% limitation the base erosion for the cantonal taxes applies. That's the reason why, even though the margin on the financing activity drops from 7 to 3.5%, the tax charge remains very stable. So, in a nutshell, a very interesting tool that we have now in our toolbox. There will be substantial work to be done in order to fine-tune the application in practice, and then we will be ready to go with our new need. And with this, I hand over back to Armin.
Thank you, Claude Alain. Before I start with my explanations on the treatment of hidden reserves to step up, in response to a question we have already received, yes, the slides for this presentation will be downloadable from the website. This will be made available after the webcast has finished. We have already received a few more questions which we will address at the end. Just a reminder to encourage you to ask questions if anything springs to mind that is unclear. Regarding the hidden reserves, the new law introduces a holistic concept of disclosure of hidden reserves. It deals with all the possible cases of entry and exit out of tax liability, be it by means of migration of a company from abroad to Switzerland, which is the case at the red left upper box, or be it upon the migration of a company seat out of Switzerland, which is addressed at the right-hand top box, or be it because of a change in cantonal tax status on the orange lower left side. Regarding the cantonal change of cantonal status, there are two rules to be kept in mind, and I will go into more details just in a second. There is the explicit transitional rule, which has now been regulated in the transitional norms of the new harmonization law in Article 78G, dealing with the treatment of hidden reserves, including goodwill, when a cantonal regime is lost or no longer available. And the second alternative that is available in case of an early loss of cantonal tax regime by means of withdrawal, for instance, of the cantonal ruling, then in certain cantons there is a possibility for an early step-up, which is not based on explicit law, but it's based on existing practice, which has been developed and protected also by the federal court in a few, there are only two court cases in that respect. Then there is a special provision also for the entry into the patent box in the middle orange. Interesting enough, there is no rule, even though it is attempted to be a holistic concept, for the exit of or from the patent box. This is on purpose because it's believed that there will be no exit requirement from the box, because A, it is advantageous for the companies that are availing themselves of the box, and secondly, the box would automatically come to an end if a company no longer would possess of patents and similar rights that qualify for the patent box treatment. So this is the overview of the cases that are covered in the law. As I said, there are two alternative options available upon loss of cantonal tax regimes, and given that this is sort of the most important topic, I guess, for most of our audience at this webcast, I will focus particularly on these two options. The two options are either to apply the current practice, which I said is available in the majority of cantons, of the so-called step-up of the hidden reserves, that previously would not have been subject to cantonal tax if the company had sold or disposed of the respective assets or business. According to the current practice, these hidden reserves and goodwill components can be stepped up into the tax balance sheet and then be amortized tax effective over the period of the amortization period, which is depending on the regular depreciation rates for tax purposes or a maximum of 10 years for goodwill. The downside of this current step-up practice is that it comes with a deferred tax effect, that companies will have to recognize at group level a deferred tax asset for the future tax benefit that comes out of the future tax effective amortization of these step-up amounts. Given that for some companies this will be a substantial downside, a lot of effort has been put into finding a different rule that would have or would eliminate this deferred tax effect. And this is the solution which has now been implemented in Article 78G into the transitional norms of the tax harmonization law. Here again, the first thing would be to determine the hidden reserves including goodwill, similar as for the current practice. But then there would be a 5-year transitional period during which the realization of these hidden reserves and goodwill in the current year profit would be carved out and subjected to a special tax rate. As you can see obviously from this slide, the early step-up has the advantage that it will have a longer lasting effect up to a maximum of 10 years, whereas the transitional rule according to the current law is limited in time to a maximum of 5 years. On this slide you see conceptually the mechanical difference between the current practice step-up and the separate rate approach according to the transitional rules. On the upper hand of the slide we see the effect of the tax balance sheet step-up, which means that based on the conformity principle the statutory profit will also be decisive for tax purposes, but then in the tax balance sheet a depreciation can be claimed for the stepped up assets so that the remaining taxable profit is reduced by such depreciation. And if we assume in this example a step-up amount of 2.5 billion and 250 million of depreciation on a linear basis over 10 years, then over 10 years this step-up amount will tax effectively be consumed by respective depreciations. But the tax benefit on the 2.5 billion in year one will have to be accounted as a deferred tax asset, which will reduce the group effective tax rate considerably. And thereafter from year 2 following, because of the release of the DTA, the effective tax rate at the group level will be increased as if Switzerland never had implemented a sort of step-up regime. Obviously for cash tax purposes the depreciations will stay effective and there is a cash tax benefit from this measure. Companies that are keen to avoid the deferred tax asset impact, they can choose, and it's a choice, for the application of the transitional rule, which actually is depicted at the lower part of this slide, where the statutory current year profit is split into 2 portions. One portion which corresponds to the realization of these stepped up amounts, to the step up potential, and the remaining amount which is subjected to the ordinary tax rate. The amount to be carved out which is equivalent to the realization of the hidden reserves and goodwill that previously would have been tax-free upon sale is subjected to a separate low rate that needs to be determined by the Cantons. It is expected that the cantons will determine that rate at about the level of taxation that is currently applicable for mixed companies in average. On the right-hand side at the bottom, you see that there is a separate tracking then required starting from the same step-up potential, whereas the realization of that step-up potential may depending on the years, depending on level of profitability, but also depending on special occurrences. And it is a risk that during the 5 years, not the full step-up potential can be tax effectively consumed, which is depicted here in this example with 950. Okay, I hope this slide explained the mechanics clearly enough. I just wanted to add, if for instance a trademark with substantial value is forming part of the step-up potential, and this trademark is actually sold at fair market value in year 3, then the full step-up potential relating to that trademark can be set off against the crystallized gain from the disposal of the trademark in year 3, and will therefore obviously reduce substantially the taxation upon such a transaction. Now, one word regarding valuation approach. In the law, there is no specific guidance. It just talks about fair market value, including goodwill. Here you see the valuation approach based on a discounted cash flow method that will start with deriving the enterprise value, but not the full enterprise value can then go into the step-up calculation, but it has to be first reduced by those components of the fair market value of the company that are not entitled to step-up treatment, i.e. the participations, because the participations are not typically subject to tax and therefore should escape the step-up benefits. Similar for real properties. Real properties in Switzerland are always subject to tax already under current rules, so no change regarding the status and treatment of real property is warranted, and therefore the fair market value of real property has to be excluded. The remaining balance composed of the fair market value of other assets, including goodwill, has then to be prorated by the amount which would have been taxable, respectively tax-free in the past. For a holding company, obviously 100% of that value is equivalent then to the step-up amount. For a mixed company with foreign source income and a 15% taxation quota, only 85% of this remaining step-up value can be taken into the calculation for either the early step-up and thereafter the tax balance sheet depreciations, or the determination of the amount subject to the separate rate under the transitional rules. Alternatively, in practice, the cantons may very much favor to stick to the so-called practitioner method. They are not so comfortable with discounted cash flow method. The practitioner method, which is laid out in the circular number 28 issued by the SSK, which is the conference of the heads and responsible at the Cantonal Tax Information for corporate taxation. This practitioner's method follows the formula that it takes twice the yield value plus once the substance value, and out of these then the average. The yield value is determined by backward looking at the last year's result and the result of the prior year, the last year's result being counted twice and being capitalized by a capitalization rate that is determined by the 5-year swap rate plus a risk premium of 7%. Given the swap rate is currently negative, the capitalization rate will be roughly 7% today. The interesting thing to note here is we have done a few simulations, is that the practitioner's method will lead to values which are about only 50% or half of the fair market value which results out of a DCF approach. So from that perspective, companies are best advised to not follow the practitioner methods, but make the effort to come up with a DCF valuation approach. One word regarding the step up for principal companies. What I told you before was relating to what happens at the cantonal level, where this alternative choice between tax balance sheet step up and the separate taxation according to the transitional rules is possible. At the federal level, for the loss of the principal allocation, there is no choice. There is only the balance sheet step-up approach possible. From a timing perspective, it is expected that this step-up can be claimed at the moment when the new tax rules will become effective, and it is planned that the Circular 8, currently ruling the mechanism of the principal allocation, is withdrawn simultaneously with the effective date of the new norms beginning of 2019. At federal level, then the step-up will put into the tax balance sheet and will follow the normal tax depreciation rates, and it's clear from the federal norms that goodwill can be amortized over 10 years. I've written here that the tax ruling is required obviously to determine the fair market value subject to the step-up. According to the rules on the cantonal level, it is an assessment notice to be issued by the cantons at cantonal level, and obviously at federal level a similar procedure can be followed. This has its relevance because of the international spontaneous information exchange of tax rulings. An assessment notice by the cantons are not sort of in scope for an international information exchange. What is in scope, though, is the current Circular 8 rulings. These rulings technically would have to be exchanged internationally if they are still applicable in 2018. You see this on the graph at the bottom, where the Multilateral Convention on Administrative Assistance in Tax Matters that incorporates BEPS Action 5 requirements will become effective. Switzerland has prepared a law that will allow Switzerland to go for that information exchange for those rulings that are still applicable in 2018. Now, we have said that the new Corporate Tax Reform 3 will become effective only in 2019, so there is an overlap from a time axis perspective, which means that companies would have to withdraw the Circular 8 ruling prematurely or early before end of 2017 to escape the international exchange of tax rulings. But if the companies want to avoid transparency more generally, bearing in mind that the transfer pricing documentation rules also require companies to disclose tax rulings in the master file and some rulings also in the local file, companies with Circle 8 ruling are best advised to consider a withdrawal of their existing ruling already with effect from 2016. The question which has been asked is what happens if the ruling is withdrawn? The answer which we have received from the federal tax authorities, and there is no official confirmed view there, but important senior officials have stated that the idea is that a company that currently benefits from a Circular 8 treatment, the principal allocation, would continue to benefit from that treatment irrespective of the existence of a tax ruling as long as Circular 8 remains applicable, which is planned to be until the end of 2018. Similarly, actually, for rulings at cantonal level for holdings or mixed company status. Also, these rulings could be withdrawn this year, and companies could make reference directly to the underlying norms in the cantonal tax laws and would not lose the privileged tax treatment simply because the ruling is withdrawn. Some further guidance on the various measures will have to be subject to further clarifications, either in an ordinance by the Federal Council concerning the patent box and the R&D deduction, or circle letters as it is for the notional interest deduction. And this is work in progress, and not all questions are already answered, as we will see then also in the Q&A. But before we go there, let's talk quickly about the cantonal corporate rate reductions, which you see here on these slides, to the extent cantons have made up their mind and also communicated accordingly. A number of cantons have announced what they plan to do. One canton, the canton of Vaud, has already passed a public vote to actually, effective from 2019, have reduced the cantonal income tax rate combined with federal income tax of 13.79%, coming down from 22.8% today, massive reduction. This reduction passed the popular vote with a strong majority of voters' approval. Other cantons have made just announcements, as you can see on the list. Geneva, for instance, targeting a 30% rate, and Zug targeting a 12% effective tax rate that always includes federal income tax. Further cantons have levels of corporate tax rates that are quite low already and therefore don't need to change. Lucerne, for instance, at 12.3%, there is a left-wing proposition outstanding there to slightly increase that rate. Not sure whether that will be supported then. Important cantons like Zurich have not yet announced what their future targeted tax rate will be, but an announcement is planned to be made. If not before the summer break, then it will definitely be after the summer holidays. What is becoming evident from this slide is also that Switzerland, from a corporate tax rate perspective, will potentially divide into two parts. The low tax group of cantons, where tax rates will range between 12 and 14%, and then the high tax cantons, where the tax rate will be rather ranging somewhere between 16 to potentially 18%. So tax rate competition within Switzerland at cantonal level may become more fierce. Where is the tax rate reduction funded from? This is funded partly, obviously, from cantonal resources to the extent they are available, but to a substantial extent it's funded from the increase of the portion the cantons benefit in the federal income tax proceeds, which is increasing from, and here's a mistake, 17%, not 17.5%, to 21.2%. This 4.2% increase in the share of the cantons in the federal income tax proceeds amounts to something in excess of 1.1 billion that the federal level, the federation, will make available for the cantons through the respective mechanism. And that will obviously spread according to the cantons, and the cantonal portion out of the 1.1 billion can be invested by the country, so to speak, into a rate reduction. In the interest of time, I'm not going into the beta factor for the fiscal reallocation of funds mechanism in detail, but would like to conclude with a few recommendations from our perspective before we go into the Q&A. I have listed here 6 recommendations. Recommendation number 1, companies should revisit the future use and benefits of keeping separate holding and mixed companies in their group structure. It may be beneficial to combine or merge these different special purpose status companies going forward in order to, first of all, achieve capital tax savings, but secondly also to potentially maximize the impact of the new measures, including taking into account the overall maximum limitation of reliefs. So if a company has certain entities in Switzerland that can benefit from a combination of reliefs in excess of 80%, obviously the excess would be wasted. By merging these companies with other operations in Switzerland that could not benefit from any measure, this would maximize the profits from which the measures can be deducted, and thereby maximize the benefits of the various measures which apply. Recommendation number 2, obviously consider the benefits of the early step-up versus applying transitional rules upon the loss of a current cantonal tax status. Here, obviously, it's also to take into account the appropriate valuation approach to arrive at the step-up amount, to determine the various hidden reserve allocations to the various assets, to model the amortization effect over the lifetime of the assets, respectively applying the standard tax depreciation rates, and taking into account, of course, the deferred tax aspects into that decision making. Recommendation number 3, consider early withdrawal of existing tax rulings. This is not particularly linked to the corporate tax reform directly, but indirectly. It is linked to the desire that may exist to avoid the international disclosure of existing tax rulings, be it either through the spontaneous international information exchange or disclosure in the transfer pricing documentation, and obviously applying then the respective base norms in the cantonal laws or the circular letters as they stand now directly. Recommendation number 4 is to plan for utilization of the R&D and patent box incentives, selecting the appropriate patents to be brought into the box, assess the entry-level taxation effects, also in combination with the step-up, assess the nexus formula impact. And it may well be about the combination with the step-up for those intangible assets that are sort of are sitting into the Swiss companies today. Recommendation number 5, plan for using the notional interest deduction by, for instance, bundling group activities, group financing activities in one company, bringing finance activities also back from locations abroad. And of course assess the level of equity financing and the arm's length interest rate that applies for group financing. Recommendation number 6, last but not least, consider bundling of substance in the right location. That is meant from an international perspective by bundling substance in Switzerland, where the tax environment may hopefully be more attractive than elsewhere, also in order to defend BEPS challenges, but also consider potential advantages of locating the activities in a different canton, especially if the activities today are in one of the cantons that is not able to lower the canton corporate tax rate substantially enough. I'm sure these are not all the possible options for maneuvering companies have, but should be the simple key 6 measures everyone should address. And that brings me to the end of our presentation and into the start of the Q&A. We have received a couple of Q&As meanwhile, and I would suggest that Benjamin starts covering his questions. that came
Sure,
in.
I can do. So we received a question with respect what exactly is the definition of software, e.g. if the software does support processes in companies. And as mentioned in my presentation, the Parliament delegated the task to the Federal Council to define the notion of other IP assets that are functionally equivalent. And as I've mentioned in the law, specifically mentioned was copyrighted software. We expect in the ordinance that the Federal Council will, in a certain degree, in detail, discuss the qualifying IPs. With respect to the copyrighted software, the idea is and was that you sell a software product and not that the software is used to support, for example, the processes within the production process. So you sell a software product. The second question with respect to the patent box was the 90% threshold and whether Cantons will apply a lower threshold. The answer to this question is yes. A canton may decide, taking a holistic view, looking at all the regimes, i.e. looking at the whole toolbox, as well as taking into account the reduction of cantonal tax rate, not to provide the maximum 90%, but a lower threshold. Based on my discussion I had with several cantons, I know that certain cantons are already thinking and calculating with a lower threshold. But in the end, the decision from a canton on applying a threshold lower than 90% is certainly also driven by an assessment of the respective canton, how competitive a canton would like to position itself on a national or international level.
Thank you, Benjamin. There are a couple more questions. Claude, there was one question also relating to the notional interest deduction. Can you cover that, please?
Yes, the question is about what happens if the 10-year federal bond rate is negative. If the federal bond rate is negative, in a previous draft of the bill, there was a suggestion to make an uplift of 50 basis points in order to overcome these kind of situations partly. However, during the parliamentary negotiations, this uplift has been withdrawn. So today we're in a situation that if the bond rate is negative, that there is on this kind of assets that do not represent intercompany loan receivables, that there will be no need because the rate will be zero.
Thank you, Claude Alain. There are further questions here which I can tackle. One of them is, what do you mean exactly by achieving capital tax saving after merging a holding company with a mixed company? The advantage would be that if you have a holding company that owns a mixed company or also further subsidiaries with ordinary status, then you typically pay capital tax at both the holding level and obviously for the capital that is injected also in the next tier subsidiary level. The same equity is taxed there with capital tax again. And obviously by merging, you can eliminate the equity that is duplicated in a multi-tier Swiss holding structure. Next question here is making reference to cantons that apply a 12% ordinary combined tax rate, drawing attention to the fact that in certain European countries there is a disallowance of tax deductions on payments, particularly royalties or interest to recipients that are taxed at a low rate. Particularly reference is made to the Austrian regime where a minimum taxation of 10% is required. And yes, with a 12% taxation rate at both cantonal and federal level combined, this 10% threshold is met. When this company also benefits from the notional interest deduction, it may well be that applying the notional interest deduction will drive the effective tax rate on, for instance, Austrian financing income to the threshold below 10%. There, obviously, today already we have this issue with Swiss finance branches financing to Austria, and solutions can be found that the respective income where such requirements must be met from a foreign perspective are subjected to the ordinary rate and not included in the NIT calculation. So it should be possible to also deal with these situations post Corporate Tax Reform 3. There is another question here which asks the profits that are subject to the low tax rate. The question, is the tax rate fixed per canton, or is the rate based on the company's mixed company ruling? The answer here is there will be one separate rate for the transitional rules, which is fixed per canton, but does not individually vary depending on the company. So if, for instance, a canton fixes that separate rate at, say, 2%, then this 2% applies equally to mixed companies as it does to holding companies in that canton. Another question here is, how will Switzerland rank internationally after the introduction of corporate tax reform foreseen in 2019? Which cantons shall eventually benefit from the tax reform? I very much like to answer the first question, how does Switzerland rank internationally after the introduction of corporate tax reform 3? We will believe from this end that Switzerland will become, after the enactment of the reform, the single most attractive tax location in Europe, even more attractive than locations like Ireland. Based on some cantons offering very low, in international comparison, baseline or headline corporate income tax rates, on top of which then the measures, as we have explained in this webcast, can be applied. Regarding the cantons that eventually benefit from the reform, that's a more tricky question, because all the cantons obviously would want to be avoiding that they lose out. It's clear that the canton of Vaud, having already made a bold step, and it's already resolved and decided to lower the effective tax rate substantially to 13.7%, may likely become part of the winners. It will be more challenging for cantons like Zurich, where we know that the portion of companies that currently enjoy a tax regime is proportionally small. And that also means that the canton of Zurich will have difficulties to lower the headline tax rate substantially from the current 21% level. And if the canton of Zurich can reduce its corporate income tax rate to, say, 18%, obviously there's still quite a significant difference between the 18 and 13.7 in Vaud, or 12%, for example, in Zug, which make companies that otherwise can't avail themselves of any other measure, be it the patent box or NIT, seriously consider potentially to relocate in the midterm. Then there is a formal question regarding procedure. What happens with the cantons that are not ready in time with their adaptation of the cantonal tax law? What does that mean concretely? Also concerning the different measures. It's a very tricky question because, first of all, in the harmonization law, in the transitional rules, it is said that the harmonization law will become self-executing if the cantons have not implemented the respective norms into their cantonal tax law at the effective date, which is targeted beginning of 2019. Now, looking at what is becoming self-executing, then it's clear that the patent box is a mandatory rule with the respective mechanics built fully into the harmonization law. So the patent box regime will immediately apply on the cantonal level as well, irrespective whether a cantonal law is ready or not. When it comes to the other measures, like the R&D super deduction, also the notional interest deduction, and also the adaptation of capital tax treatment, there the federal harmonization law says it is up to the cantons to decide whether or not they would like to adopt these measures. So what is becoming self-executing is that the cantons can apply these norms, and obviously in the absence of the cantons actually having applied them by means of respective rules being entered in time into their cantonal laws, this can norm loses its effect. So it's technically self-executing but without effect, except for the patent box, except for the step up upon entry into tax liability. These are essentially the two harmonization law norms that are self-executing directly and not can norms for the cantons. There is, I believe, the last question. I have to see whether I have dealt with all of the others. Question is understanding correct that the cantonal income tax will be left at the discretion of the cantons? And what is about the federal income tax rate? Yes, it is correct. The cantonal income tax rate is in the autonomy of the cantons and the cantonal legislators to set that, whereas the federal tax rate, the 8% effective rate which we have today, remains unchanged. So it's the Swiss effective tax rate will be a combination of the current 8% effective rate at federal level plus what the cantons will enact in their cantonal tax law. And as I said, Vaud is the canton that has already enacted a combined effective tax rate of 13.7% is the result there. I think that has dealt with all the questions which have come in today. We are few moments before the hour. I would like to draw this webcast to a close with the remark that, again, the slides will be downloadable from the website after the webcast. Also, a recording will be made available if you want to share or re-listen certain parts of what we said. Feel free to do so. Otherwise, it remains to say that the PwC technical core team that has heavily worked on the crafting of the Corporate Tax Reform 3, we have spent quite a significant amount of educating our colleagues in the corporate tax teams in the various offices. They are ready for your questions, so please reach out to them if there are any further questions. Obviously, also we hear the speakers of this webcast. We are available for further questions offline. And with that, I would like to thank you very much for your interest, for your attention to this webcast. And we are looking forward to being in touch with some of you in the course of the implementation phase as it progresses, with first the popular vote at federal level and then with the cantonal implementations that will follow thereafter. Thanks again for bearing with us at this hot Wednesday afternoon. And I wish all of you a very nice evening, and thanks again, and bye.